As of this moment, shares of Rigetti Computing are trading at $1.12, down 0.03 cents, representing a drop of 2.61% in today's session. Now, seeing a small-cap tech stock down a couple of percentage points on any given day is hardly unusual, but the immediate story here isn't this minor intraday fluctuation. The real, unspoken headline hiding behind that number is the company's desperate fight for survival, recently underscored by a 1-for-10 reverse stock split. This wasn't a move made from a position of strength. It was a compliance maneuver to keep the stock from being delisted from the NASDAQ. So while the ticker shows a price above $1, the market is telling us a story of a company whose valuation was collapsing, forcing its hand to artificially inflate its share price. This is the critical starting point that most casual observers miss. They see the promise of quantum computing, but they overlook the raw financial mechanics of a business burning through cash at a blistering pace. The general expectation for a company like Rigetti is straightforward. It's a pure-play, high-risk, high-reward bet on the future of computation. Investors who buy into this narrative see a small, agile player positioned to capture a piece of a potentially trillion-dollar industry. They envision a future where Rigetti's quantum machines solve problems currently deemed impossible, from drug discovery to financial modeling. The belief is that if you can tolerate the volatility, you could be holding the next big thing. That is the story the company wants you to believe. However, the reality is far more precarious and complex. This isn't just a technological race, it's a brutal war of attrition against behemoths. We aren't talking about a startup competing with other startups. Rigetti is in a direct line of fire with the research and development budgets of Alphabet's Google, IBM, and Microsoft, not to mention other heavily funded private firms like PsiQuantum and IonQ. The reality is that for every small step forward Rigetti takes, these giants are potentially taking giant leaps. The expectation is a sprint to innovation. The reality is a marathon for funding, and Rigetti is showing signs of exhaustion. Let's dissect the recent stock movement to understand this tension better. The volatility in RGTI is not the healthy, growth-oriented volatility you see in a stock like NVIDIA stock, which moves on massive product cycles and data center demand. Rigetti swings are event-driven and highly speculative. Look at the trading volume. On a typical day, it might be relatively thin, suggesting a lack of consistent institutional interest. Then, a press release about a new processor or a minor partnership will cause volume to spike dramatically, driven by retail traders on platforms like Robinhood or SoFi Invest piling in, hoping to catch a quick multi-bagger. This pattern is indicative of a stock that is traded, not invested in. There's a fundamental difference. Long-term investors, the kind you find using Fidelity Wealth Management for their Fidelity IRAs, look for sustainable growth and a clear path to profitability. Speculators using a Robinhood app for Robinhood stock trading are often just looking for the next momentum play. Rigetti's chart is a map of these speculative bursts, followed by long, painful fades back to its baseline. The reaction to its recent earnings reports further exposes this dynamic. On the surface, the numbers can sometimes look encouraging. The company has been successful in growing its revenue, often beating analyst expectations on the top line. This is the morsel of good news that bulls cling to. They see revenue growth from their quantum computing as a service platform as proof that the model works. But the reality is found further down the income statement in the net loss and, more importantly, the cash burn. Rigetti has consistently posted substantial losses, and there is no clear timeline for when that will change. In the current macroeconomic climate, with high interest rates, the market has zero patience for cash-burning enterprises without a definitive path to self-sustainability. A company like Apple stock can weather economic storms because of its fortress balance sheet. Rigetti has no such luxury. Every dollar it spends on R&D is a dollar it must eventually raise from capital markets, potentially diluting existing shareholders further. This is why when you manage your individual brokerage account, you must differentiate between a company investing for growth and a company spending for survival. Many investors using online investing tools from providers like Interactive Brokers are becoming increasingly sophisticated in spotting this difference. They see the negative cash flow and understand that unless Rigetti secures major transformative contracts, another capital raise is not a matter of if, but when. So what does Rigetti actually do? The company designs and manufactures superconducting quantum processors. In simple terms, think of them as the heart of a quantum computer. Their business model is centered on providing access to their quantum machines via the cloud. This QCaaS model is smart because it allows companies, research institutions, and governments to experiment with quantum algorithms without needing to build and maintain their own incredibly complex and expensive hardware. They are effectively trying to become the Amazon Web Service of the quantum world. The company was brought to the public markets via a SPAC, or a Special Purpose Acquisition Company, back in 2021. This was during the peak of market froth, when speculative technology was all the rage. The initial hype was immense, but as the market turned and the realities of its financial situation became clear, the stock plummeted from its post-SPAC highs, leading to the reverse split we discussed earlier. This history is not just a footnote, it's a cautionary tale about market sentiment and the danger of investing in a story without scrutinizing the balance sheet. It's a classic case study for anyone learning about self-investing or using investing sites to build a portfolio. You can't just buy the narrative, you have to buy the business. Looking ahead, the future of Rigetti hinges on a few make-or-break scenarios. The bullish case, the one that fulfills the market's initial expectation, relies on a series of significant catalysts. First and foremost is a demonstrable technical breakthrough. The company needs to showcase a quantum machine that can solve a commercially relevant problem faster or more efficiently than a classical supercomputer. This is the elusive concept of quantum advantage. Achieving this would be a monumental event, likely sending the stock soaring, as it would validate their entire technological approach. Another major catalyst would be the announcement of a large multi-year contract with a Fortune 500 company or a significant government agency like the Department of Defense. This would provide a stable, recurring revenue stream and, more importantly, signal to the market that its technology is ready for real-world applications. Imagine the impact of that kind of news on a small-cap stock. It would fundamentally change the conversation from survival to growth. We also can't discount the possibility of a buyout. As the quantum space consolidates, a larger tech or defense firm might see value in acquiring Rigetti's IP and talent, providing a quick exit for shareholders. However, the risks are just as potent and arguably more probable in the near term. The primary risk, as we've established, is the cash burn. The company's financial runway is finite. If they fail to secure new funding or substantial revenue before their cash reserves are depleted, the consequences could be severe, ranging from massive shareholder dilution to bankruptcy. Competition is the other existential threat. Google's Sycamore and IBM's Eagle processors represent incredible technological achievements from companies with virtually unlimited resources. They can afford to invest billions over decades without needing to worry about quarterly earnings reports. Rigetti does not have that luxury. It's like a small speedboat trying to navigate the wake of several massive aircraft carriers. Finally, there's the overarching technological risk. The fundamental science of building a fault-tolerant quantum computer is one of the hardest problems in engineering and physics. There is no guarantee that Rigetti's specific approach with superconducting qubits will be the one that ultimately wins, or that a breakthrough won't be followed by an unexpected technical wall. When considering this type of investment, it's why sophisticated investors often use platforms like the Fidelity Trading Platform or Interactive Brokers Platform to set tight stop losses, because the downside can be a complete loss of capital. For those managing their own portfolios, perhaps through a SoFi Active Investing account or a Fidelity brokerage account, Rigetti represents the far end of the risk spectrum. It is not a stock for a conservative Schwab Intelligent Portfolios allocation. It is a speculative bet. Now, I want you to think about this timeline. Comment below with the year you believe we will see widespread commercial quantum applications that genuinely impact industries. Be honest, is it 2030, 2040, later? Your answer to that question should heavily influence how you view a company like Rigetti today. If you believe that timeline is still decades away, then you must also believe that Rigetti will have to navigate a perilous financial landscape for years to come. In conclusion,